And there is a clear tech bubble here, and we're going to see the Nasdaq declining by 85%, just like what we saw in 2001. And this bubble is bigger. I wouldn't be in that. So I think people would need to be careful here in terms of what they see with Bitcoin. And if you look at the long-term chart, also you can see that there's a clear divergence on the weekly, which tells us that a bigger top is coming for Bitcoin. Not here. I think it's going much higher. So it will be a difficult landscape to navigate in. The cycle, probably holds. And I think, within the next 50 days, you could probably see a top in the Bitcoin, and it could be a much higher level, as I said, than where we are now. But I also see that the business cycle rolling over at this time. So that's quite different. And I think that what I see technically in Bitcoin, that this is a massive top you have here.
History has a habit of humbling people who think this time is different. Henrik Zeberg, head macro economist at Swiss Block, warns that Bitcoin is nearing a major top, not just a cyclical peak but a secular one. In his view, the charts suggest a high is forming within the next couple of months. There could be one last push higher, but the setup points to a multi-year downturn once the broader economy rolls over. Zeberg says risk assets like Bitcoin are still coasting on momentum. But momentum doesn't protect you when the business cycle weakens, and the real economy is already showing cracks. Jobless claims, slowing growth, and deteriorating confidence all point in the same direction. Once that weakness is undeniable, risk assets won't be spared. Some hope that the Fed will ride to the rescue just as it has in every downturn of the past 2 decades. Zeberg agrees they'll step back in with cuts and liquidity injections. But here's the catch. This time, stimulus won't have the same impact. Households are already stretched, and the appetite to borrow and spend is weaker. Instead of driving growth, new money will circulate faster through the system, feeding inflation. That's the real shift today. It's not ETFs or fresh narratives that define this cycle. It's the fact that stimulus itself is now inflationary, not stabilizing. In that environment, Bitcoin may not be the safe escape many believe, but another casualty of a harsher business cycle. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. Thanks for watching.
This time is different, first of all, which is not. So I don't buy that. It's the narrative we hear all the time. We hear it again and again. This time is different. And then something comes up, and then we see that it's not different. The cycle, probably holds. And I think, within the next 50 days, you could probably see a top in the Bitcoin, and it could be a much higher level, as I said, than where we are now. But I also see that the business cycle rolling over at this time. So that's quite different. And I think that what I see technically in Bitcoin, that this is a massive top you have here. This is not a cyclical top. This is a secular top in Bitcoin, which means that we are you can see it's crashing to much, much lower levels than most people can understand. So this time is different with the ETFs and all that. Take the .com, narratives and put it in and put the digital, sprinkle on it, and you have the narratives of today. It's really about the real economy. The real economy is rolling over, and I cannot emphasize that more. When it does that, there's no going back. The risk asset, and Bitcoin is a risk asset, will crash. So you're going to see Bitcoin is going to have a very good time for the next few weeks here until the top, and also with the cycle. And then I think it's going to be a really, really bad asset to hold for the next few years. And then we'll have to see because I can only see down the road that the Fed will come back in again. But if you look at it, what they have done is, as I said before, they have reintroduced inflation. What do I mean by that? If you look at a chart, a 10-year yield chart for the last 100 years, you can see how the cycle goes up and down in terms of yields, which follows inflation. And if you look at it, you can actually see momentum-wise that it shifts in 3 phases. So from the 20s until the 70s, after the Second World War into the 70s, you had an inflationary trend. Then Volcker came out and you had a deflationary trend. And now we are actually at the bottoming end of this, and we see that we have a significant shift in the momentum. That's why the Jeff Gonglacks and so on are telling us that they're going to short the bond market, because in the long time frame here, they see that yields will go higher. If that happens, you are in a completely new setup from what we've seen over the last 5 to 10 years. You are now in an inflationary environment. I mean, just think about what our grandparents would say, or our parents would say back in the 70s. If you said, you know what? Every time the economy rolls over, we'll just the tiniest bit, we'll just sprinkle some liquidity on it, a lot of it actually, and more, and everything will be fine. You know what they would tell us? They would say to us, how can you do that? You'll get inflation. Why would you do that? Then you'll get inflation, you'll crush the consumer even more. And this is what people do not understand. That's really what is different this time, is that we have reintroduced inflation with the stimulating into COVID in a crazy manner when the supply chain was actually breaking down. That was the inverted Volcker moment, which reintroduces inflation on a secular basis. And in that world, you cannot sprinkle liquidity on everything and just get a better outlook. So I think you're going to see the Fed come in and, excuse me, and then they will try to do the same thing again, but they're going to find out that the free lunch is over. The free lunch is over now. There's inflation that actually will kick up, not immediately. They may do a bounce in the market and the euphoria may come out for some time. But in the longer time frame, I think you're going to see something that is much, much worse. And that is an economy that is not reacting to stimulus, because Mrs. Johnson there, she doesn't go and borrow that $100 extra. And that means that the stimulus packages on the QE side will not help. They will not be as stimulative and they will not really help to turn the economy. But what we'll see is that the money that starts to be injected will start circulating faster, and that creates inflation.
Henrik Zeberg isn't calling the top just yet. He says he's still holding risk assets because the final phase of a cycle can climb so sharply that it shocks almost everyone. That's when he plans to sell. Still, he admits if someone decided to scale back now, he wouldn't try to talk them out of it. The late-stage surge can be rewarding, but it's also the most dangerous part of the ride. What Zeberg refuses to touch is crypto. His reasoning is simple: history. Bitcoin has collapsed more than 70% in past downturns, while the Nasdaq has typically fallen only 20 to 30%. If this really is a tech bubble set to unwind, possibly on a bigger scale than 2001, then Bitcoin stands to suffer far more than equities. He points to long-term chart divergences that already signal a major top forming. That doesn't rule out another push higher, but it strongly suggests that the eventual downside will be severe. So where does he see safety? Gold. Zeberg argues that if you're determined to hold through the turbulence, gold is the cleaner play. Unlike Bitcoin, it has a track record of preserving wealth in downturns. In his view, gold isn't about chasing upside, it's about surviving what comes after the peak. Let's get back to the interview.
I think it depends on, how risk adverse you are. And I would say that navigating, as I said, in this whipsaw kind of environment where you can get first a blow off top, a deflationary bust, and the Fed comes in and all these stagflation maybe also, it'll be so difficult. So there may be some will say, well, I want to ride it out. What should I do? Then probably if you ask me that, should I just buy now, hold on to? I would say gold, even though I think gold has had a big pullback in deflation, in a deflationary bust. But in the 5-10 years time frame, I wouldn't be worried. It would be gold. And you could just look at the SPX versus gold. Actually, it's now breaking down. We've only seen 4 times in history: 1929, 1971, and 2000, and now it does it again. But that's for another day. So you have these. But there will be less. Sometimes just having cash would also be good. And just having having zero on your minus the inflation, of course, it will be deflated away to a certain degree. But just having cash could be a good situation for some people. So it depends on their risk appetite there. Mine personally, well, I have a lot of risk assets here because I think I will still be able to pull it out in a good time. I don't think we have the top, anywhere near the top here. I would say time-wise closing in. But the final phase of it can be so steep that most people will not, really understand how steep it can be. So I think I'll be selling into that. Other people may find it right to take the chips off the table now. Would I be in any kind of anything that is related to crypto? Absolutely not. Absolutely not. I mean, Bitcoin has crashed 4 times by more than 73%, while Nasdaq was down 18, 20, 25%, 30%. Bitcoin was just, crushed. And there is a clear tech bubble here, and we're going to see the Nasdaq declining by 85%, just like what we saw in 2001. And this bubble is bigger. I wouldn't be in that. So I think people would need to be careful here in terms of what they see with Bitcoin. And if you look at the long-term chart, also you can see that there's a clear divergence on the weekly, which tells us that a bigger top is coming for Bitcoin. Not here. I think it's going much higher. So it will be a difficult landscape to navigate in. One asset would be gold if you had to hold it on through it all. If not, well, some cash would be good as well. And maybe, even hold the dollar. I'll be going long the dollar as much as I can. When I think the top is in, because I think there is a, shortage of dollars the moment you start to see deflationary bust going, and the restructuring processes and so on will simply demand dollars to get settled. So that will send the dollar up strongly, and then after that, well, it'll be commodities and gold and silver and the likes, because it will be in a time of stagflation.
What stands out in Maller's argument is the inevitability he sees in this shift. The scaffolding that once held up the dollar-dominated system is showing strain, and capital is already searching for new homes. Gold remains the familiar fallback, but Bitcoin represents something different. Not just another store of value, but a structural alternative that rewrites how money itself works. The pace of adoption may differ from one investor to another, yet the underlying theme is the same. Trust is leaking out of fiat, and it has to settle somewhere. Whether policymakers acknowledge it or not, the competition for monetary relevance is already underway, and the decisions made over the next few years could determine which anchor the world clings to. As trust in traditional debt markets erodes, will investors gradually rebalance into gold and Bitcoin side by side, or will Bitcoin's technological advantages ultimately draw the bulk of confidence away from legacy assets altogether? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.